The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, fellow ACCA members, and thank you for joining today's session on IFRS 17, Insurance Contracts in collaboration with Ernst & Young. My name is Danish Shamsi, and I am the Regional Business Development Manager for ACCA Middle East. I lead the Regional Employer Strategy at ACCA, and I'm also responsible for supporting our small to medium-sized accounting practices in the region. IFRS 17 is effective from annual periods beginning on or after the 1st of January 2023 and is not too far from now. This session aims to provide a high-level overview of the standard, key talking points, and some accounting considerations. We have two presenters today with me, Govind Ram Khatri and Bilal Kamar. Govind is a director with Ernst & Young in Dubai and specializes in providing IFRS advisory to audit teams within the firm. Govind has 15 years plus experience of providing IFRS advisory to audit teams and clients, and he is actively involved in providing IFRS related training in key IFRS areas. Bilal is a director in the Financial Accounting Advisory Services Department of Ernst & Young Middle East, North Africa, and Bilal is also currently based in Dubai. Bilal has over 20 years of experience, out of which 13 have been specifically spent on IFRS technical reviews, IFRS convergence, and UK GAAP implementation. Bilal is Ernst & Young MENA's solution leader for insurers and is an expert on IFRS 17 technical interpretations and implementations for life and non-life insurers. As always, should you have any questions at all, please drop them in the question panel and they will be answered at the end of the presentation. Thank you to Bilal and to Govind for joining us this afternoon to deliver the session. And thank you to all of our fellow members for taking the time out of your afternoon and keeping up to date with the latest professional development. So I will now be passing it over to Govind. Thank you very much.
Thanks, Danish. Hello and good afternoon, everyone. Very welcome on this session on IFRS 17 insurance contract. As Danish mentioned, I'm joined by my colleague Bilal Kamar. So we will take you through the journey of IFRS 17. And if we look at the objective of today's session, we aim to provide you with a background on IFRS 17. And then we will look into the what we call it the new concepts introduced by IFRS 17. And most importantly, we will understand what are the changes that new standard is going to bring in terms of the reporting of financial statements. And of course, at the end, we will have a Q&A session. So feel free to type your questions and we will try to answer as many of them as possible at the end of session. So moving on to the next slide. Okay, so Bilal, we know that IFRS 4 on the insurance contract is already there. What is this new standard IFRS 17 all about? Is it going to replace IFRS 4? And what is the effective date of this new standard?
Okay, thanks, Govind. So the first point in terms of why standard setters have brought out IFRS 17 is the main primary reasons they wanted to bring out was to ensure a consistent framework of the accounting for insurers and all insurers really should be in place. So as we know, IFRS 4, which was an interim standard issued on a grandfathering basis. So like what that means is obviously insurers prior to issuance of IFRS 4 were having certain accounting policies and practices, so they were just following that. And then we saw that many deviations happen. So for example, a very simple thing is that certain insurers had outstanding losses on their balance sheet on a gross basis. Others had it on a discounted basis. Some insurers brought in some other prudence-based reserves like equalization provisions and things like that. So there wasn't a consistent framework, and then there were a good few areas where a consistent guidance was missing. So the purpose of IFRS 17 was to ensure to bring in that element of consistency across the market. In terms of IFRS 17 is going to supersede, is going to replace IFRS 4. The effective date is 1st January 2023 from ISB, although we know that there are certain jurisdictions like India, like Egypt, where the standard has not yet been endorsed for implementation. So they probably are likely to have a later implementation date. Thank you.
Okay, thanks, Bilal. Now that we know why IFRS 17 was issued, could you briefly tell our audience what are the key components of the standard?
Yeah, that's fine. So I'll just move to the next slide and just quickly talk about some of the key areas or key components. So the way we look at IFRS 17 is by looking at it into three pillars, really. And when we really start from the end result, where we need to get to, which is the presentation and disclosure element. And obviously that would mean that we need to have a fully compliant set of financial statements. A year prior, we will be issuing a pre-transition note, to reflect the effect of, or a tentative effect of IFRS 17. To get to here, what we need to establish is the key accounting policies. So, and in between the measurement principles or the measurement policies, you can call it methodologies as well, to get to, so a combination of accounting policies and actual models will sort of get us to the presentation and disclosure of the financial statements. So the key ones I think we will be looking at during the session is level of aggregation, which I think mostly the view is that is one of the game changers within the IFRS 17 world. And there are a few other key accounting policy changes. In regards to measurement, we can say it's probably a 360-degree change compared to IFRS 4. However, the key elements we can look at by looking at the next slide, probably, in terms of the measurement models introduced by IFRS 17. Sorry, I'll just probably go it. Okay, so in terms of measurement models, what IFRS 17 does is it introduces one consistent measurement model called GMM, General Measurement Model. It used to be called Buildings Block Approach. So what that does is it requires entities to pretty much follow a cash flow based approach. So really model the cash inflows and cash outflows. And basically measure the liability accordingly. There is, we can call it a change or a deviation from that measurement model in case certain features are met, which is called variable fee approach. So this is predominantly applied to those contracts where insurance discretionary participatory features are sort of involved. Examples of that would be unit-linked contracts, variable annuities, with profit contracts, and this is probably the most complicated measurement model within IFRS 17. Recognizing that what the standard setters have recognized and allowed for is the need for the short-term contracts, especially in the context of Middle East, where a lot of insurers sort of are doing the motor and medical insurance predominantly or fully, and those are really 12 months contracts. So recognizing that for 12 months contracts the need for cash flow will be very complex, so they have allowed for a premium allocation approach, a simplification to general measurement model, which is relatively similar to the current UPR, gross premium accounting model, which most insurers follow. Although there is obviously a requirement of onerousness, which they have tagged at to that. What that means is, for all contracts, we're not going to wait until the negative deviations sort of have developed, as current insurers sort of account for, let's say, premium deficiency reserve or unexpired risk reserve. But we have to forecast the profitability from the very beginning of the contract, and measure that part called loss component, at the very initiation. So that's one of the changes, and we will talk about slightly more in terms of when we talk about level of aggregation. But those are, the key measurement model changes requirements introduced by the standard.
Okay, that's good to know, Bilal. Let's now move on to the aggregation requirement of the standard. So can you talk us briefly about what level of the aggregation is required or permitted under IFRS 17?
Sure. Thanks, Govind. So I guess that is probably IFRS 17 is probably the only standard where specific requirements for unit of account for various different things exist. As we know in other standards, there have been clarifications and stuff, but this has come, through the standard process that the level of it. So we'll just quickly talk about those. So first level, what we have to get to is the portfolio, and that's very important. Number one, because a lot of our determination of the groups will be dependent on what's the portfolio, and later on when we look at the financial statements, we will only also see that the financial statements presentation, that is the balance sheet presentation, is going to be impacted by the portfolio. So how do we determine portfolio? Now, IFRS 17 being a principles-based standard, obviously, although in certain areas it has been, you can call it prescriptive, but those are very, very limited. Generally, it's a principles-based standard. So what they have allowed for is they've given guidance that, okay, if you have similar risks and if they are managed together, then that's a portfolio. What is similar risk? This standard has defined that, what they're saying is if the type of risk is not consistent, the type of risks are different. For example, motor and medical, in certain understandings, you could interpret it as like within motor we have motor third party and motor comprehensive liabilities as well. So in that case, they some entities also interpret them as similar risk. Different risks. So at the end of the day, what you have to see is that the cause of the risk which is causing the damage, if that is covered under a policy, that is similar. And if it is if you need a different policy to be issued, and this is obviously a general definition in reinsurance, certain whole of account treaties, that's not how you will apply that. But like in most cases, that's how we will interpret the similar risk, that it is covered through a single contract. Managed together is a bit which is not defined in the standard. It is something which is more interpretative in nature. So the guidance around it is like, if the insurance company manages the claims, together. So for example, if they had certain motor damages and the incidental medical recoveries also come through, then you could probably look at it as managed together, like a similar risk. But obviously, if the company has a fire policy and a motor policy, they probably don't tend to be managed together. They are different underwriters, different processes to sort of get them. So considering this guidance, and this comes with an and. So both conditions have to be met together for a line of business or for a product or for a combination of products to qualify as a portfolio. That is number one. Then underneath it, you obviously have three groups of contracts. Three minimum groups we identified. One is the onerous group. And here, the definition of onerous is simple, that, if it's a loss-making group, determining the onerous group is obviously the challenging bit. So how do you go about doing onerousness assessment? Because you are really determining it at the beginning. The first day the contract is recognized, that is where the onerous contracts sort of need to be recognized. So obviously that is challenging, and there are obviously some practical ways of looking at it. So if, let's say, if this is a premium allocation approach determined policy, like companies tend to look at combined ratios and stuff to determine onerous contracts. These are GMM policies. Companies need to perform a CSM, a contractor service margin calculation, which is like the full liability calculation to get to the profit element. And if the company is not earning profit, then they will recognize its onerous. So there are lots of practical challenges around determining onerous contracts. And the second, or probably take the third first, which is easiest, is the other one, which is your profitable group. And third is which is the middle one, resilient. This is where, your contract is recognized and you don't have a significant possibility of becoming onerous. And you could look at it from the example that, okay, so I have, let's say, a motor contract for customer A, and to get the premium top line or other commercial reasons, the entity wrote it at, let's say, a loss ratio of 105%. We knew that it is a loss contract, so it goes into onerous contract. If you flip the example and the company wrote it at, let's say, a 55% loss ratio, you know that it's a clearly profitable contract, and there are no challenges, at least. But let's say it's the person's loss history is very volatile. Like they have been 100% now. Maybe next renewal they were at 90%, then following on they were like at 110%, then following on to 70%. So the very volatile history. So what you could look at it is, okay, well, I've written a customer which is not onerous now, which is the left bucket, and clearly profitable now on the right bucket, but it doesn't have a significant possibility as well of becoming onerous. And this is the initial assessment. So you put it in the resilient bucket. So we started with motor, let's call it, we started with portfolio. Let's say motor was the portfolio. Motor will be broken into profitable, loss-making, and resilient buckets. Then, as I said, there are some prescriptive requirements. So this is one of the prescriptive ones, that we have to have an annual cohort. So for example, a customer wrote a contract today. Now, they were profitable. When they renewed the business, they are still profitable, no changes in risk category. But just because the two contracts are 12 months apart, so they cannot be in the same cohort. They need to be a different cohort, which means different group. So the way you look at a group is profitable, so portfolio, so motor, onerous, and let's say 2021 business. That's the level. The significance of this group is that all the measurements under IFRS 17 are at the groups of contracts level. Hence, determining the cohort carefully is obviously quite important. Just one practical point to add is, if you see across at least Middle East, there have been various interpretations of cohorts. Obviously, annual cohort is the maximum allowed under IFRS 17, but we will find examples that where companies are, for example, seeking quarterly cohorts. So they will have lots and lots of groups. And obviously, this depends on the insurance valuation solution that the company would have, or insurer would have chosen. So that summarizes just the level of aggregation requirements of IFRS 17.
Okay, thanks, Bilal. Now that we know about the key concept, the level of aggregation, let's take a deeper dive into the different measurement models, or perhaps a comparison between existing model under IFRS 4 and IFRS 17 models as well.
Sure. Okay. Thanks. So if we look at on the left-hand side, what we have is like, what do we do with the current IFRS 4 insurance measurements or presentations, and then we can look at on the right-hand side that if we go under IFRS 17, what happens? So we know that the current approach applied is you take the premium, you sort of calculate an unearned part of it. and you put that on a liability on the balance sheet. And if the premium is not collected, the receivable sort of sits on the asset side of it. In life companies, like where there is a requirement of unbundling applied, then we potentially see some of the investment contract liabilities as well. But obviously, in the region, there will be very few who does that. So we also, if the company has paid commissions, they will have DAC on the balance sheet. But what's happening here is that the gross receivable, the gross unexpired liability, which is UPR, the gross expired liability, which is claims, reserves, any sort of payables, are all booked gross on the balance sheet. And sometimes people also put what you can call it a safety margin, that is an amount of reserve over and above the appointed actuaries or internal actuaries recommendation of the IBNR or of the reserves. So that's the current model. Now we switch to the IFRS 17. So what happens is, and you will see that when we look at the GMM or VFA, we see very different elements. So essentially the context and the concept in GMM model they brought out is you break your premium which you have received into four components. So you look at basically your best estimate cash flows. So if I look at my premium and look at a pricing model, let's say I expected claims under the policy, let's say 80%. So the fulfillment cash flows obviously will have the estimate of those claims. Now, let's say my starting point or for the premium was $1,000, and I know in that I built in an 80% loss ratio or 80% combined ratio, I should say, and that will give you the combined the best estimate reserve of 800, in that. Now, one important point to highlight is that it is the best case estimate. It's not any prudent liability, what IFRS 17 recognizes. This is a difference between IFRS 4 and 17. 4 talks about a concept of liability adequacy test, and then you're not required to put it within certain limits. There's no mandatory requirement. Whereas the standard says, okay, well, if you have a distribution, IFRS 17 says if you have a distribution of fulfillment cash flows, you pick the best estimate out of that. So in our example, the 1,000, let's say, was the premium, 800 is the best estimate outflow, which includes your related expenses like acquisition cost and expenses. So when you net them off, you come to 200. Obviously, there is a requirement to discount them. So the period over which these cash flows happen, an implied assumption would be that for 1-year contracts you go to PAA. So we are really talking about the contracts we're talking about here are more than 1-year contracts. So you discount it for the time value of money. You also then, and let's say in our example 200, you put a discounting of 10. So now you're left with 190. Now, the last element is the risk adjustment, which is the quantification of non-financial risk uncertainty. So this is not discounting or financial risk impact or credit risk impact. That's not that. Credit risk impacts and stuff we expect, or in standard expect to be built into the best estimate cash flows. What risk adjustment is the volatility, in your severity, in your frequency, in the movement of pricing. So any sort of non-financial risk we will have to quantify, and then generally you would see that this is something typically will be provided by the actuarial function of the insurance company. So let's say the risk adjustment in my example of 1,810 of discounting, where we're currently at 190. So we apply another risk adjustment of 20. We apply a risk adjustment of 20. So the 170 in our example left with is the profit, which is the contractual service margin. This is what we will take it to insurance revenue, plus the movements in expected costs and expected risk adjustment. So, but the contractual service margin is very important, because in this example, if I flip the scenario, let's say 1,000 was a premium and expenses, my best case estimate outflow, let's say was 900, we left with 100, we discounted for 10, 90, and we have a risk adjustment of 95, we end up in a negative contractor service margin, and that concept doesn't exist. So that means it's a loss component, it's an owner's contract. And that 5 will be recognized it straight away. Whereas if it's a positive contractor service margin, which is the 170 which is calculated, that will be amortized over the life of the contract. On the liability side, the requirements introduced are, okay, best estimate reserve. So any sort of unnecessary safety margins to be released. We will discount it based on the claim settlement pattern. And we also have a requirement of calculating risk adjustment. So the volatility and non-financial risk on the unexpired liability side, that is, sorry, on the expired liability side, that is on the claims. So we will have risk adjustment on both sides of it under GMM and VFA model. The main difference in VFA is that the time value of money also goes into into contractor service margin and not recognized separately. When we go to PAA, the accounting is relatively similar, as I mentioned. So we start with premium received, we take away premium earned, and just book the acquisition cost in the measurement of liability as well. So rather than a separate DAC, as you can see on the IFRS 4 side, we have that built into the liability calculation. One important point is that the PAA model starts with premium received, not necessarily premiums due. So any sort of due premiums or receivables will be eliminated out of the balance sheet. So balance sheet strictly represents the cash liability on the premium received side. Obviously, earning happens on the total premiums. Same thing on the DAC side. So if DAC is not fully paid, so that will have the receive or the outstanding side or the accrued side will be eliminated out of the balance sheet as well. For liability for incurred claims, so the first part, which is the unexpired risk, the 4 blocks under GMM or the big yellow block under PAA, this is called liability for remaining coverage. And the block below, which is expired risk, is basically liability for incurred claims. Liability for incurred claims, the model is consistent and same across all measurement models. Liability for remaining coverage is what changes across the GMM, VFA, and PAA measurement model.
Okay, thanks, Bilal. So now let's talk about the financial statements presentation. Would IFRS 17 presentation remain same as we currently have under IFRS 4?
Okay, so I guess one of the key changes, as you can see on the P&L, is that the gross premium is going to sort of disappear away, and we will have a new measure called insurance revenue. For PAA accounting, it's not as dramatic because what insurance revenue suggests here is mainly your earned premiums. So it's really your gross premium minus the UPR effect, which is here. And any sort of bad debts which was on receivables is also going to be netted off here. Although I think for the bad debts part, I must say there are some other different interpretations, but majority I think is aligned with that the bad debts will go into insurance revenue here. And this is primarily because of the B126 of IFRS 17, which talks about that you take expected receipts into consideration when you talk about insurance revenue. So for PA, it's not as dramatic. For GMM, what you see is the revenue is a mixture or is a combination of the contractor service margin we talked about, the earning part of that, as well as the movement in expected costs. So this is probably one of the biggest changes, that those expectations of costs were never really developed previously, at least by the non-life insurers. And those movements now have to be captured in insurance revenue. So that number could look very different year on year. In total, obviously, it will always reconcile to the total premium. So that's probably one of the bigger changes. The other biggest changes you can see on IFRS 17 side, that we have categorized the insurance margin, which is the first 2 lines, revenue and service expenses netted off, and then reinsurance are separated out. That the insurance margin and reinsurance margins are really separate. They don't act like what we have been used to, that we start with premium, we net off the reinsurance effect of that, and then we go to claims and we net off with the reinsurance effect. So that net presentation has gone away. And that is obviously one of the biggest changes. as at least the presentation changes from the IFRS 17 perspective. And third, I think most important thing, especially for those who write long tail policies, is the impact of insurance, finance, income, and expenses, where the discounting impacts basically arising out of the LIC, the liability for incurred claims, and any sort of other financial risk, that is the currency impacts, or any other current, or for reinsurance, the credit risk impact, are going to come into these two lines called insurance finance income and reinsurance finance income, with marked with the N. So these are the new lines which are never previously existed, for the insurers. Others are more grouping changes. I think one of the changes one of the key changes brought up by the standard is the concept of expense allocation. So obviously, in the current practice, actuaries tend to use, or underwriters tend to use the acquisition cost as part of or for the valuation of premiums, but the administrative expenses, to allocate those to policy level, that was a bit variable practice between the companies. Now, what the standard setters have brought out is that those admin expenses, or the attributable part of those admin expenses, have to appear in service expenses. So basically, the very last line, the second last line on IFRS 17, which is G&A expenses, that will be left with only the non-attributable expenses, while the attributable expenses will move into the insurance service margin and the insurance service expenses line. So those are the key P&L changes. We can quickly look at the balance sheet changes. So on the balance sheet, what you have is, as I mentioned before, that the liability now, the LFRC, the liability for remaining coverage, is now measured with a starting point of cash received. So if the cash is not received, it doesn't go on the balance sheet. It's a liability. So you can see the receivables, which are in IFRS 4 have sort of gone away and will not be presented separately on the balance sheet. On the liability side, it's more cleaning up the balance sheet, bringing all the elements together, on the liability side. So those are some of the key changes. The last thing which I probably should cover on the presentation side is, I think if you recall, we talked about in level of aggregation the concept of portfolios, and that's what is a key driver. So we have an example up on the screen. So let's say we have certain contracts with premiums. I assume that these are the portfolios in this example: consumer, commercial, long-term life, and medical. You could, your own company have different portfolios as well, but obviously this I've used for the illustration. We see the contract terms are variable. We have premium received, we have commissions, which is the expense amount, and the commissions paid amount. So when we calculate the LFRC, we start with premium received, which is 7,500 for consumer, let's say, and the full amount, we have assumed that these have been earned. So the premium earned is 12,000. This is similar to the box, the formula which we saw in the box for comparison of the various measurement models. So we have premium received, premiums earned, commissions, and commissions paid. If we net them together, we come to an asset position on the FRC side of 4,200. When we bring in the LIC, the liability for incurred claims, and obviously these are again some illustrative numbers of outstanding losses, reserve, IBNR, and the related risk adjustment. So we come to an LIC of 2,800. So if we knock off, if we total LFRC and LIC, what we get to is a asset position, because the LFRC in asset position is higher than the liability. So what the standard is telling us is, after doing this exercise, if you get to the asset position, versus if you see the similar calculation in long-term life, for example, where I get a liability position, you need to aggregate all your asset positions together and all your liability positions together and put them on the balance sheet like that. So on the balance sheet, these insurance contract assets will be an aggregate of all the assets. This insurance contract liability will be an aggregate of all the liabilities, and same thing goes with the insurance contracts as well. And this obviously is quite a significant change, because now we eliminate receivables, so it means businesses will have to track receivables outside, commissions payable have to be tracked outside, and the portfolio level valuations have to be done. So a lot of system changes are required. So I think those are key presentational changes.
Thanks, Bilal. It's very helpful to understand how the presentation of the financial statements is going to change under IFRS 17. Any IFRS training is not complete without a discussion on the disclosures. So can you talk to our audience about what are the key disclosures required, or what are the key things that we need to focus on in terms of application of IFRS 17?
Okay, so as you mentioned, any new standard is not complete until new disclosures are required, and IFRS 17 comes with a lot of quantitative and qualitative disclosures. The key one, like I'm covering here, is what we call it liability roll forward disclosures. So the disclosure which is up on the screen, basically what the objective of that is that it reconciles the opening liability with the closing contract liability, and same thing on the reinsurance side as well, that the opening contract asset will reconcile with the closing contract asset position. And this is the disclosure which is applicable for all measurement models. So it doesn't mean that a simplified approach will sort of help escaping that. What we see or learn from this disclosure is that like what the standard setter has done is really brought out all the relevant elements into the into the reconciliation. So obviously you can see the three columns. One is the profitable LFRC, other is the second in the middle is the onerous contract component of that, and third is liability for incurred claims. So LFRC, the combination of that is the first two, and LIC as the third column, and obviously any LFRC plus LIC gives us the total contract liability. So this disclosure is at the highest level. You can do it at the segment level. Those segment levels are going to be aligned with IFRS 8 segment disclosures. Although companies may choose to present it at the lower, like let's say like portfolio level as well. So I think that is where the interpretation of each and every insurer, that what are their respective segments, is going to come into play. But having said that, let's say we have 4 portfolios identified by an insurer, and the segment, in terms of segment, they are mapped to one segment. So if you have different assets and liabilities position, the roll forward table, you can do it at one, but obviously what the insurers need to do is to break the first line, which we're presenting insurance contract liabilities, into liabilities and asset components. So keep the liability and asset movement separately, and identify for each segment that what were the assets and liabilities which were netted off, because the balance sheet presentation is at a portfolio level, not at the segment reporting level. So that means obviously if companies choose to do a segment level disclosure, then there's a reconciliation required to align with what were the results based on portfolio. Second key thing we learned from this is that the data points here are so granular. Means like if you look at the current systems, current systems basically capture, let's say, premium income at the policy level. A lot of those do not capture premium receipts at the policy level, because mostly generally premium receipts are captured at the customer level. Expense allocations are not performed today at the policy level. So really the granularity, you need the policy level detail of all those components to map to the groups of contracts, and so that all those groups you can map to the portfolio, and portfolio can be mapped to the segments. So it's really a chain, which is obviously not manual. Most of the IFRS 17 denominated solutions will do it. But what it means is the data granularity at the policy level you need to ensure, which is obviously one of the biggest challenges to source. And lastly, for onerous contracts, that the estimation of which contracts are expected to be onerous, and disclose the movements. That is, what are the more onerousness or the less onerousness we sort of identify through the life cycle, what are the let's say the discounting impacts of that of the loss component. So it's very granular data requirements which are required for the roll forward table. If we have GMM and VFA measurement model, then an additional table is required. So this is basically allocating the data points based on the three blocks that we saw in the GMM slide. That is estimate of present value of cash flows, which is in fact your inflows minus the best estimate outflows, and then and we have discounting there as well. So three components bulked up into one, which is estimate of present value, and then we have risk adjustment and contractual service margin, which were the individual blocks in the calculation sheet we showed before. So for GMM VFA, as with the calculation, the disclosures are also complex. So you have to produce not just this one disclosure, but an additional table as well to track the movements. There are a number of other quantitative disclosures like sensitivities and like claims development on a present value basis, which are also required. But I think if we talk about the key and the biggest change, that is this liability roll forward. Thank you.
Okay, thanks, Bilal. Can we go on to the first slide, Bilal? I think one of the important points that we possibly missed is the interaction between IFRS 9 and IFRS 17. So maybe can you talk to us briefly about it?
Yeah, sure. So with our current IFRS 4, obviously there is an allowance provided to companies to defer the application of IFRS 9 and bring it in line with IFRS 17 implementation date, effective date, which is 1st January 2023. So that's obviously an option allowed, and what it means is that if the companies have designated certain financial assets in a certain way, they have the ability to redesignate those at 1st January 2023 based on IFRS 9. The benefit which companies and especially from the implementation exercises we see by deferring it is there are a lot of elements which are what you can call it interdependent. So for example, IFRS 17 talks about doing the non-performance risk, which is the essentially ECL on reinsurance balances, but then it doesn't tell us how to do it. So obviously we can leverage on IFRS 9 to build a policy as to how that will be done. Similar cases for some of the impairment requirements on receivable side as well. And lastly, that to allow for to avoid the mismatches between how the liability measurement works and asset measurement works, the ALM strategies or the duration matching strategies, especially the life companies which employ, are going to be very helpful with the coordinated data of IFRS 17 and 9. So that's like in summary how the things will align.
Okay, and then in terms of the project management, what suggestion will you give to the audience in terms of how to tackle this project to implement IFRS 17?
Yeah, so from the implementation exercise, what we have seen is that there are at least three main components of IFRS 17. One is doing all your design work. Other is implementation of IFRS 17 solution and taking all of that to GL, which is the third part. And so to make sure that we start as soon as possible, but also not to miss the GL integration part, which we have seen in quite a lot of implementations. That people have thought about design, people have thought about how the IFRS 17 system will be configured, but they are not really only thinking about the GL integration. So that's probably a very important point to consider regarding that. And obviously, the implementation does take time. I think the average time we can see for system implementations is like between 5 and 7 months. So to start as soon as possible. These are the probably two key advices from my side.
Okay, thank you. Thanks, Bilal. It's very useful. Let's look at some of the Q&As. So let me just read out them and then we'll try to answer them one by one. The first question that we got here is that with new standard in place, will there be change in the pricing from the insurance companies and in which industry?
Yeah, so I think this depends really on the model and on the if you are following the rating factor model or market pricing approach. So so if we were after premium, if we were a premium driven company, and we had lots of onerous contracts, then you would expect companies to realign the pricing. So I think that probably we would see in some cases. I think the other thing you would see is like for third-party business, motor third-party business, we see a lot of onerous contracts across different companies. So probably that segment and certain individual medical segments where, let's say, the infants and the children insurance, like the cost seems to be quite significantly high. But this is more on generalized basis that, if we take a market view rather than a company's view, we can see some of the changes happening, and pricing may also be impacted.
Okay, fair comment. So let's move on to the next question. Is IFRS 17?
Yeah, is it useful for other companies to apply?
Useful for other companies to apply, or only the insurance company needs to apply this?
Yeah, so it doesn't say that it is for insurance companies only. It is whenever a contract written has significant insurance risk. However, if we just look at some of the development and evolution of that, especially when the ISB came out with the credit cards requirement for IFRS 17, it was very significantly opposed, by non-insurers, because obviously banks, for example, are a big beneficiary of that. So we would probably not expect many other sectors to apply IFRS 17. Obviously, it's a lot more challenging because you need to have actuaries, you need to have accountants who understand insurance, you need to have IT infrastructure. So I think it comes with a lot of challenges for any non-insurer to apply it, and it may also not be applicable to it. So, obviously, non-FS sector will not be impacted. There are certain banking products which may get impacted. And then that has basically been the view that if it meets to certain criteria, for example, the insurance pricing is built into their pricing, into credit cards pricing, then it's not IFRS 9, it's IFRS 17. So I think if we look at from that perspective, it is probably going to be useful for some of those sectors which have products with insurance risk, like mortgages and credit cards. However, it comes with a lot of challenges and technicalities and difficulties to apply as well. So just to keep in mind.
Yeah, I think this is a very interesting one. So technically speaking, any contract which meets the definition of the insurance contract, which has a built-in insurance risk, is subject to IFRS 7 requirements.
Yeah.
Let's move on to the next one.
Okay, so the next one says, what are the changes in accounting for recording insurance premium as insurance policy holder? Well, if you're a policy holder, you obviously will not have any changes because the standard applies to the contracts the entities issuing the contracts, not the beneficiaries of that. Yeah, it is the changes actually at the end of the issuers who have to start recording the liability based on cash received basis rather than accrual basis.
Okay, that's great. So we don't have any further questions. Anyone from the audience have any question, please feel free to type in the question box. In the meantime, let me just recap what we have covered so far. So thanks, Bilal, very much for your presentation and input into it. So we started with why is there a need for IFRS 17? And what is its effective date? Then we looked at the key concepts introduced by IFRS 17. Then we looked at the level of aggregation required, and we had a deeper dive into different measurement models required or permitted by IFRS 17. And then in the end, we looked at the presentation and disclosures requirement of IFRS 17. So that's all we covered. We got one more question, Bilal, there.
Is IFRS 17 is prospective? Okay, so this is the transition question. So the primary transition method is fully retrospective approach. For the insurers who are short-term insurers or who issue short-term insurance policies, obviously the application of fully retrospective approach may not be that challenging. But those who issue sort of, medium-term contracts like, construction all risk or engineering all risk type contracts, those will find it challenging. So considering that IFRS 17 also allows for modified retrospective approach. So this is retrospective approach, but not go to the very inception of the policy, which the fully retrospective approach requires. Considering again that the standard is issued for the whole industry and not for certain insurers. So life insurers in particular may impact significantly with this requirement. Of they probably would not have data available for in a number of cases, especially when they have acquired portfolios, let's say from their respective banks or from other companies. So IFRS 17 also allows for fair value approach to be applied. So you have three approaches available, and it's the proof of burden is on the insurer that if they can apply for a retrospective approach, then that's the approach applicable. If we do not have that, we go to modified retrospective approach, or if both are impractical to apply, then you go to fair value approach for transition.
Okay, fair comment. So it brings now towards the end of our session. I think on overall basis, IFRS 17 is a new standard, as we all know, which means that it's a little complex on the first time application. If we look at the application by the insurance company, typically the first time implementation will involve a phased approach, like you start with the assessment phase and then you design your solutions and the policies and so on, and then you implement it, run it parallelly, test it, and then you reach to the actual live application of the standard. So it's kind of appears to be a very lengthy process, and which most of you would have actually started working on it if you are a part of the insurance entity. Other than insurance entity, as Bilal mentioned before, impact is not likely to be material. It's only relevant to those contracts which meets the definition of an insurance contract as defined under IFRS 17. So Bilal, if I ask you for your closing remarks or maybe 30 minutes recap or advice or suggestion that you can give to our audience, that will be helpful.
Yeah, the suggestion really, I think the key suggestion or the key takeaway from me from our all IFRS 17 implementation projects is start looking at your data, as soon as possible. That is one of the most significant challenge, in application of IFRS 17. Also, I think I mentioned earlier the GL integration part, because most of these IFRS 17 solutions don't give you the combined P&L balance sheet. So start looking at it as early as obviously possible and feasible. I think those are the two key things. If I was to take away from here, those are the ones which we would suggest companies to do. Otherwise, I think obviously there are lots of elements, as Govind mentioned. Typically the implementation exercise ranges to be between 3 and 5 years. From the assessment phase to actual implementation. Some companies in like say in APAC, Asia Pacific region, we have seen even taking longer than that, which are predominantly life companies. But start working on your data as soon as possible, and start aligning your GL integration processes. That's where I think we see that there are gaps in the industry. But otherwise, obviously there are many other points as well. Thank you.
Okay, that's good. Thanks, Bilal. Thanks, audience, for listening to us. And if you have any questions or comments, you can still type it, and then we will try to connect with the ACCA and try to answer your questions as many as possible. Back over to Danish.
Hi everyone. Unfortunately, Danish had to drop to another call. So thank you, Going and Bilal. On behalf of ACCA, thank you so much for supporting us with this session. And thank you all to the attendees for joining this session. The recording for the session will be available on ACCA Middle East YouTube channel by this evening. And we look forward to welcoming you all in our next webinars. Thank you.
Thank you.
Okay, thanks everyone.
Bye. Have a good day. Bye.